All right, let's pull back the curtain on a true Wall Street legend, Peter Lynch. Today we're going to demystify his incredible investment strategy. It's called GARP, and it's all about finding fantastic companies before they come with a crazy price tag.
You know, for most of us, the investing world feels like it's split right down the middle. On one side, you've got value investing, hunting for safe bargains, but man, it can be slow. And on the other, you've got growth investing, chasing those exciting, fast-moving companies, but taking on a ton of risk. It always feels like this frustrating choice between playing it safe or, actually making some real money.
But what if I told you that you don't have to choose? Check out this number. For 1977 to 1990, Peter Lynch delivered an average annual return of 29.2%. I mean, that's not just good, that's an absolutely staggering number that just crushed the market. And he did it by completely refusing to pick a side. And just to wrap your head around what that 29% really means, Lynch took a fund with about $18 million and turned it into a $14 billion behemoth. This wasn't some lucky streak. It was a system. A repeatable system that found that perfect sweet spot between safety and massive growth.
So, here's our game plan for breaking down his method. We're going to start with that classic dilemma, then get into Lynch's brilliant solution. We'll uncover the one key metric he used, explore his amazing storytelling framework, and then we'll see how you can actually use these ideas yourself in today's market. So Lynch's true genius was creating this hybrid approach that just solved the investor's dilemma. He called it GARP, which, as you can see, stands for growth at a reasonable price. To put it simply, GARP is all about finding rockets before they've really taken off. You want companies that are growing fast, that are growing consistently, but you just refuse to overpay for them. You get all the exciting upside of growth investing, but with a smart, disciplined approach of value investing.
This table really lays it all out perfectly. You've got value investors on one side. They're all about protecting their capital. They have a really low tolerance for high prices. Then way over on the other side are the growth investors, aiming for huge gains and willing to pay pretty much anything for it. And right there, smack in the middle, that's where GARP investors live. Their goal is high returns adjusted for risk. And their tolerance for high prices is moderate, it's flexible, it always depends on the growth. It's truly the best of both worlds. So the big question is, how did Lynch actually find these sweet spot investments? Well, he had a really simple but incredibly powerful tool that helped him figure out if a growing company was still a bargain. He called it the PEG ratio.
So most investors, they just look at the price to earnings, or PE ratio, to see if a stock is cheap. But that's just a snapshot in time. The PEG ratio is dynamic. It answers a way more important question, which is, okay, but how cheap is this stock compared to how fast it's growing?
And the formula itself, it's almost shockingly simple. You just take the company's PE ratio and you divide it by its annual earnings growth rate. That one little calculation gives you a totally new perspective on what value really is.
And this example right here shows you exactly why this matters so much. Okay, so at first glance, Company A with a PE of 10 looks twice as cheap as Company B. But the moment you factor in growth, the whole story flips upside down. Company A is barely growing at all, which gives it a really high PEG of 5. Meanwhile, Company B is growing at a blistering 30%, which gives it a PEG of just 0.67. Suddenly, Company B is the real bargain here.
And the best part is, Lynch gave us a clear target to aim for. He said a PEG ratio below 1.0 is attractive. That's a sign a stock might be undervalued. But if you could find a company with a PEG around 0.5, that was the holy grail, the perfect GARP opportunity. A true bargain on a fast-growing business.
But here's where Lynch was a true master. He knew that numbers alone were never enough. The other half of his strategy was all about the quality of the business. It was about really understanding the story of the company you owned. And to do that, he broke the entire market down into 6 simple categories.
You can almost think of these categories as different characters in a play. You've got your reliable dividend payers, those are the slow growers. You have the giant, steady companies like a Coca-Cola, those are the stalwarts. And then you have his absolute favorite category, the fast growers. These are the small, aggressive companies that could become what he called 10-baggers, stocks that can return 10 times your initial investment. Okay, this table is basically your playbook. Once you categorize a stock, you know exactly what to do. With a stalwart, your goal is a solid 30 to 50% gain, and then you sell when its price gets too high. But with a fast grower, the source of those 10 baggers, you're looking for them to expand into new markets, and you only sell when that growth story finally slows down. Each category has its own unique rules, its own plot. It's brilliant.
And this leads us to what might be Lynch's most empowering idea of all. He believed that regular, everyday people, like you and me, have a built-in advantage over the pros on Wall Street. He called this the scuttlebutt method.
I mean, don't just take my word for it. Listen to the man himself. He said you can find the next huge winners just by paying attention to what's going on around you. That great new product you see, or that service everyone's suddenly talking about, that could be your starting point for research.
And this isn't just some nice theory, right? This is how he actually found some of his biggest winners. He discovered Dunkin' Donuts just because he was a customer and loved their coffee. His investment in Hanes, that one returned 30 times his money. And it started because his wife noticed their legs pantyhose were suddenly being sold everywhere. The clues are all around us.
So to make sure you really understand the story of your investment, Lynch came up with this simple test. He said before you buy a single share, you should be able to explain, in just 2 minutes, why you own it, what needs to go right for it to succeed, and what could possibly go wrong. If you can't do that, you haven't done enough homework. Simple as that.
Okay, so that all sounds great for the 1980s, but does this strategy of combining numbers and a good story still work in today's super fast-paced, tech-driven market? Well, the answer is a resounding yes.
Let's look at some recent data. A company like Logitech, for example, fits that stalwart/grower profile perfectly with a PEG ratio just under 1. And then look at Photronics and Axos Financial. Both are growing incredibly fast, but their PEG ratios are way down below 0.5. According to Lynch's framework, those are classic fast-grower GARP candidates, right here, right now.
Because at the end of the day, the companies might change, the technology might change, but the fundamental challenge for an investor never does. Lynch's GARP strategy gives you a timeless framework for cutting through all the noise and focusing on what really matters, finding real, sustainable growth at a price that actually makes sense.
So the next time you're out or at work or just talking with friends, keep your eyes open. Ask yourself, what amazing product or company is sitting right here in front of me that maybe Wall Street hasn't discovered yet? The next 10-bagger, the next stock that could change everything for you, well, it might just be hiding in plain sight. Thanks for tuning in.